today I wanted to talk about trading the US dollar volatility squeeze. Excited to get your guys' take on this. I did some analysis around, FX markets compared to all other asset classes have been a little bit less volatile in recent months, euro dollar in particular compressing. Wanted to validate that thesis and see if there were any opportunities and what pairs are moving right now. So let's go over to the next slide. I'll get into the numbers of what I did. Looked at just the past 6 months, get the recent view on markets right now, the landscape of major US dollar pairs, 7 of those covering basically the entire globe of major economic players: euro, pound, Japanese yen, Australian dollar, Canadian dollar, Swiss franc, and New Zealand dollar. Did some little crafty math tricks to normalize some of those daily changes in price and calculated realized volatility using some standard deviations and compared a 20-day look-back window to a 60-day look-back window and made a ratio out of that to tell which pairs are ramping up in volatility and which are compressing. So let's go over to the next slide. We've got the table for you, and this validated a few things that us on the desk are looking at and not too excited about. This euro dollar, most popular market in the world and most popular market for U.S. retail customers to trade because of its low margin requirement and high liquidity and just general ease of understanding about our exchange rate between the euro and the US dollar. That volatility ratio coming in to 0.79, so that's below 1, meaning that the 60-day daily volatility is greater than the 20-day, so that really coming in. And we saw that pretty much across the board of these dollar pairs, hitting the Japanese yen the hardest, euro, even the Australian dollar, which tends to be a more volatile pair than both of those other ones, and definitely exhibited those traits in the beginning of the year with those tariff shakeouts. The Australian dollar, definitely the vehicle that some of that risk-on, risk-off sentiment was passed through. And what was interesting to see was that the New Zealand dollar hasn't been as affected by this volatility squeeze, that ratio staying around 1%, and the outperformer from a volatility perspective, the Canadian dollar, so that pair, that North American pair that is historically lower volatility just because of the relative geographic proximity, has been moving quite a lot, and we'll get into what possible trade setups there are there with that ratio expanding to 1.14. Does this surprise you guys in any way? What do we think about the methodology?
I think when it comes to the difference in the volatility ratio, I think it's certainly interesting with some of these pairs that have been moving, showing a lower ratio here. Like you mentioned, the New Zealand dollar USD on the opposite side, but like the dollar yen. Mm-hmm. What do you make of that pair? Like, why? For me, I would have expected it to be maybe. I guess the volatilities are matching more.
Yeah.
That's why we're seeing that, but
yeah, and that one's interesting because it kind of gives you an opportunity to you reflect and separate volatility from price level. You think, oh, I've been seeing this dollar yen at all-time extremes, 20-year, 30-year extremes. That should be more interesting. But when you look at the numbers, it appears that although we've had a few days where we've had some reclassifications higher or lower, it's been more of a continuous drift. And since some of those repricings on political regime shifting, we've really been stuck in a range of daily moves that are more predictable than we've seen, not in terms of direction, but in terms of daily pip range, or in this case, percentage-wise. And what's also interesting to call out is when you think about this from a retail customer experience, tradability. For you guys looking at some single name equities and the options landscape, these percentages must not be very interesting at all. But what are you talking about? None of these are above, I mean, even 0.5%. Well, why do we care about this at all? But when you factor in the leverage that comes with these pairs, that's why this euro dollar is so popular, because you get leverage on that pair of 50 to 1. And most traders in all landscapes tend not to look further than that, but you actually do have some of these other pairs that are built out from a product perspective. In the same way, this US dollar, Canadian dollar, also 50 to 1 leverage. Australian dollar, Swiss franc, and New Zealand dollar, all 33 to 1 leverage, margined at 3% there. So definitely more tradable products out there than just this euro dollar when it gets compressed in these volatility ranges. And still, the common denominator on all these pairs is US dollar on one half of the story. So while there could be some more nuanced drivers to learn from a fundamental perspective, half the story, half the narrative already there with that US dollar component.
Yeah, this is great data, Glenn. I mean, really, and great call out, like the idea of leverage. And again, it's all relative, right? Like these are all low compared to things that we look at day to day. But of course, I mean, these are currencies. I remember when I was in grad school, I tell you, some of these professors, they just live to bust balls, man. Like, they would bust balls just like I'm about to bust your balls, just to make an example. Like how you said because there's two, right? There's actually two that are above the ratio of one, right? And it's interesting looking at like those two first. Any specific reason why you think those two above all?
Yeah, I mean, when you look at a fundamental perspective, this year for Canadian dollar and really the commodity currencies across the board, New Zealand dollar, Australian dollar, which surprised me not to follow that narrative. We've had similar shakeouts when it came to the April lows and some tariff volatility, but for the Canadian dollar, which has really been pressed on lows recently, a lot of drift higher to the US dollar's favor as a result of that tariff landscape, has really started to come back on some fundamentals of their own, getting some growth in their economy, starting to get their unemployment rate under control. That was up near 7%. So a lot of good things coming out of Canada specifically that allow this kind of idiosyncratic mover in just this pair as opposed to other US dollar pairs. New Zealand similarly back against the wall, pressing at lows, highs for the US dollar there. So just some more movement in those in nations independently as a result of their fundamental drivers, but we still have a lot of uncertainty on the table as it pertains to U.S. tariffs, U.S. interest rates, and that side of the story as well.
You're right. It's a trip that Australian dollar and New Zealand dollar, like those aren't closer. Any guess of how far New Zealand and Australia are? Closest distance.
Kilometers or miles?
Wow. Whichever one you want to do. What's the closest distance between Australia and New Zealand?
I'm going to go 300 miles.
What do you got?
I'm going to go 299.
Wow, I framed that one. and you are no good. That is rude.
Closest, shortest point. Shortest point, yeah. Oh, okay. Shortest point across the Tasman Sea between Tasmania and Fiordland being around 924 miles.
Ooh, take that, Mikey.
Yeah, 900.
That's what you get undercutting me.
So, yeah, closest without, closest.
That's pretty
Sad.
far.
That is pretty far, actually.
Yeah.
Thank you. Next level stats provided by Jamal.
Thanks.
Let's kick it over.
Your stats.
Let's kick it over to the next slide, and we'll take you through this dollar CAD. Give you a look at. We were looking at volatility only. Let's now lay on top of it the recent price action, and you'll see that a lot of this volatility came from this big Canadian dollar comeback. But that's only in the recent 3 weeks or so. So that's a lot of where that 20-day realized volatility is coming from. But it does set up a lot of possible trade ideas. I mean, here we've got, from the time frame we're looking at, we've had some volatility compression in the past 5 trading days here. If you'll look, very inside days. And so if you're respecting the elevated volatility and you are getting some compression within this expansion, it sets up, one for mean reversion traders. You can try to get a little bit of scalping out of this range, which looks to be between 138 and 137.50. That's a pretty tight range to try and get any sort of profit out of, but it also gives you, a pretty tight range of knowing when you could be wrong. If this is a spring that is loaded and ready to pop in either direction, then you have those tight bands to know when this landscape categorically changes back a reversion to the upside, or trading through new lows as we've tested the past 2-3 days here to the Canadian dollar's favor. So this one very interesting to look at, some huge moves that we might get some possible reversion in to the US dollar upside, or we trade through this kind of congestion period. And if we zoom out, the Canadian dollar's been a lot stronger in years before. So historic price action to both sides. And then let's kick it over to the next slide, and we'll compare that to the Japanese yen, which is running well below its 60-day baseline. And we've seen, now you can see this is much more of a drift higher, which is unusually quiet because this pair is, from a retail perspective, margined at 5% right now, because that's reactionary to the increased volatility in the pair. So a regulatory move to make this margin requirement higher. But this, as we know, won't always be the case. We see a lot of historic reversion in the FX space, and there's no real fundamental reason why this dollar-yen pair should be compressed and over a long term find a less volatile environment from the way I see it. So it's just a matter of when this starts to pick up again. And so that could mean patience for now, but we've got a Bank of Japan meeting tomorrow that could be the catalyst. We've expecting them to hike 25 basis points before. The Bank of Japan has surprised before, and this hike, although it would only take them to not even 1% interest rates, 0.75%, that would be the high of the cycle. They've been historically low for many, many years, and so they are starting to turn up the dial there, and that hasn't meant so far a stronger currency. So we could start to see off that catalyst, some reassurance for this yen that could take this pair back down to more historically normal levels, or we could also see a surprise to the other side of just a verbal threatening of trying to hike these rates. And if that doesn't come into effect, we could see this go through new highs without any sort of US dollar component to it. So it's always nice when you're looking at all these markets from a US trader perspective to have some of this idiosyncratic risk on the other nations' side of things if you're looking at just US dollar pairs, because that does present more trading opportunities, potential trading opportunities with the same side from the US perspective. And we've also got just some more US data. Part of the reason why this US dollar volatility's come in so much has been a result of a hangover effect of the government shutdown. One, not getting data in a timely fashion. Two, not trusting it or not thinking that it's valid. So as we start to shake some of that out, we could start to see the volatility tick back up in all these pairs. But I thought it was a really interesting exercise to see just which ones are still moving and which are compressed the most. So key takeaways here on the next slide. Just respecting what the market we're looking at, right? Not trying to say, this dollar Canadian dollar pair is historically very low volatility, so I expect it to stay that way. If it is starting to move a little bit more now, have to respect the ranges. But what these do is compression might mean smaller take profit stop loss levels, but it also gives you a historic basis for when these things start to change, when the new ranges could be established, and take directional positioning after the fact, and not have to take a direction, a long-term direction, without all the information. Whereas if you are in a pair like US dollar, Japanese yen, this could mean that you're getting, for long-term traders, a better price point in either direction, that it'll come around, even though we aren't seeing as many unique price points right now fluctuating. If you have a directional thesis, you could expect in the long term that this volatility could pick back up, and if you think it's a cheap price right now and you're comfortable holding on to it, then you can position yourself in this lower volatility environment, and react to when things start to pick up.